it's pretty clear the market is not a huge fan of the max decentralization. Centralized exchanges have significantly more users and volume and trading flow than decentralized exchanges. We'll see where the market goes, but again, like our North Star is always like building great product, and building great product is this very multi-dimensional thing.
This episode is brought to you by Katana, a DeFi-first chain built for deep liquidity and high yield. You'll be hearing more from them later in the show. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubinek, joined today by Eugene Chen, the co-founder of Ellipsis Labs, someone that I think a lot of people in the technical Solana world have a lot of respect for. You're very deep in the weeds of market structure and just how Solana trading really works at a base level. So excited to be chatting with you here live at Permissionless. Eugene, thanks for coming on the show.
Glad to be here, Jack.
So I think we'll just start by getting an overview of what you're doing with Ellipsis Labs. You built Phoenix, which was this order book exchange on Solana, and now you've moved on to building Atlas, which I think is like a layer 2 that's applying a lot of the principles of Phoenix in like a more granular way. But I don't want to tell your story for you, but just explain kind of what you're building with Ellipsis as it stands today.
For sure. Yeah, we've done a lot of different things at Ellipsis Labs. The first product we built was Phoenix, as you mentioned, limit order book exchange, fully on-chain on Solana. So that's traded probably about $75 billion of total notional lifetime volume. And then more recently, we launched Gavel, which is a token origination platform on Solana, with the goal being to create a place for fully on-chain token launches without the need for market makers, without the need for centralized exchanges, because they charge a lot. And to do that in a way that doesn't lose a ton of value to on-chain MEV. We also are building the Atlas blockchain, which, as you mentioned, is a layer 2 blockchain, really taking a lot of the lessons we learned from building Phoenix to make Atlas as developer-friendly as possible and also as exchange-friendly as possible. So instead of being some very general-purpose block space, we've designed Atlas in an extremely opinionated way to be as good as possible for high-frequency trading and other similar types of applications. Happy to get into some of the details there later. And then, we recently announced that we're the developers behind SolFi, which is the largest on-chain market maker on Solana.
Mm-hmm. And before this, you were a Math Olympiad champion or something like that.
Champion is a little generous, but I spent a lot of time in middle school and high school doing math contests.
Yeah, that's my quant. So why are you working on Atlas now? And are you kind of moving on from Phoenix, or will part of the Ellipsis team be maintaining Phoenix and part is building Atlas? Like, what's the interplay between those two exchanges?
Yeah, so Phoenix was always designed to be a proof of concept. If you recall back in 22, there were all these arguments about AMMs versus limit order books. It almost seems like we come back full circle there with the limit order book narrative showing up again today. And to us, it was very clear that the limit order book can deliver higher quality liquidity than the AMM, at least for some major token pairs, where you need to be able to provide tighter liquidity as well as profitable liquidity, because the AMM liquidity provider often does not care if they make money, or they're tricked into thinking that they're making money when they're actually making a bunch of minus EV trades. And so we put Phoenix out into the wild. We were or I guess we still are, like the primary market maker on Phoenix. And at the time when we launched in early 2023, the total on-chain volume on Solana was like $20-30 million per day. And today that number is like 100 times higher. So things that were true about the market structure then are no longer true today. Landing transactions has become significantly harder. There's like a lot of art to it. There's like compute optimizations that need to get made, and if the goal is for on-chain verifiable finance to compete with traditional finance, you need the microstructure to allow that. And we found that Solana was a little bit too limiting here, and we didn't have enough control over the sequencing layer. One way to think about it is on a centralized sequencer layer 2, you can control all of the transaction ordering, and you can do it in a way that is benevolent, that is not necessarily revenue maximizing in the short term, but you're just trying to make, you can try to make the layer 2 as good of a home as possible for a specific application or a specific set of applications. Whereas on the layer 1, just like some random guy around the world is running your matching engine for 1.6 seconds. They can fuck with everything they want to fuck with. And then even if they're nice to you, 1.6 seconds later, there's somebody else doing it. So it turns out it's like very difficult to run an efficient exchange in that type of environment. So that's the primary reason for building Atlas. In some ways, I view it as just like a very long detour for us, where I view Ellipsis Labs as an application company first, and infra company like way second. But when we looked at the market, and still today looking at the market, we just don't see any other places you can build, the next version of Phoenix. So the next version of Phoenix is going to live on Atlas, and yeah, we haven't done too much active maintenance of the current product for a while.
So Phoenix will essentially become Atlas?
Phoenix will be call it the flagship product on top of Atlas.
Gotcha. Okay. And that problem you described of not having a potential bad actor having like a monopoly on transaction ordering or something along those lines, does that get solved by multiple concurrent leaders? And sorry if I just butchered explaining that to you, but
yeah. So the fundamental problem is what we call like the proposer monopoly.
Yeah.
It is definitely addressed to some degree with multiple concurrent proposers, which effectively nerfs the power that any single validator has at any given time. It's not clear that it gives you quite the level of fidelity as the centralized sequencer, but of course there are other trade-offs you're taking on with a centralized sequencer, including trust.
So, and maybe to back up for people who don't know about multiple concurrent leaders, at a very basic level on Solana, one leader every 400 milliseconds gets to propose and
every
add a block
1.6
to the blockchain.
seconds, yeah.
And there improvements are being worked on that'll probably come out in the coming years on Solana, where instead of one person having that like leader monopoly on the block space for some amount of time, there's two leaders. So maybe if one is malicious, you can forward to the second or something like that.
Yeah, in particular, this change is going to force ordering to be done not by the leader, but by the protocol. So you can already do this with a single leader, where the leader chooses which transactions go in, but they don't get to control the ordering. And then in that world, it turns out they can still do a lot of things to mess with the contents of a block to make money. And the more leaders you add, let's say you have 4 concurrent leaders, then it becomes very difficult to censor, and it becomes very difficult for, or more difficult, let's say, for some validator. I don't even want to call them malicious. Let's just say greedy.
Sure.
For a greedy validator to really mess with the execution of any given transaction.
But you're still saying even in that world where, and this is not something that's been proven in the real world yet. So even in a world where multiple concurrent leaders can happen, you still think there's trade-offs that make a layer 2 preferable.
For sure. One easy example is with the centralized sequencer layer 2, you can have truly continuous block building, whereas on the layer 1, with or without multiple concurrent leaders, you're still limited by this abstraction of a block time.
Maybe let's zoom out for a second, which is, to my understanding, you have some like TradFi market making experience, or just
very little,
more of a sense maybe of how traditional markets would work. And as you said, there's often little understanding of how market structure really works in crypto. AMM liquidity providers might be losing money, but they think they're gaining money because of the yield that it shows them on the screen or whatever. What work does crypto need to do, like in market making, and conceptualize for me how far behind crypto markets are efficiency-wise from TradFi markets?
I think there are areas where crypto markets are extremely efficient and extremely liquid. For example, if you look at the BTC perpetuals on Binance, the spreads are extremely, extremely tight. There's always liquidity. There's always liquidity for like pretty good size. And then when you go into the on-chain markets, sometimes the market structure starts to break down. It is really complicated, right? Because there are so many different actors along the supply chain. So you're starting from, the user who is touching some application. The user plus the application create a transaction, maybe through a wallet. And then that transaction needs to find its way over to the leader. Usually there's like a few hops along the way, maybe some transaction landing service, maybe through Jito, maybe just through a vanilla RPC. And then the leader may do some stuff to your transaction. So it's a much more complicated supply chain than I click a button on Binance. Binance is like this total black box, front end, back end, all put together, whatever. And it kind of just happens, even though behind the scenes, you have a bunch of market makers doing this like very intricate dance to try to like provide the best liquidity possible while not getting picked off. On chain, there are just like so many more permutations of the same game. And I think because the market is changing so quickly, right? Like what is the dominant application? What is the dominant wallet? How is the who is modding their validator software? This is changing very quickly. And so like the more the game is changing, the less efficient you expect it to be.
So weirdly, this is like our third Lightspeed episode of the past like 5 that's dealt with CLOBs. So I'm going to spare you explaining to me why central limit order books are superior to AMMs. Reference prior episodes or go ask ChatGPT if you'd like to know. But assuming that that's known by our listeners, I want to ask just going more deeply into Atlas, like as you're building this L2 central limit order book exchange, what things are you finding that are like really important for users? What do you think that a lot of the current discourse, if it is discourse around CLOBs, like misses? Just like give me your perspective on all that stuff.
I guess first to push back on your premise, I wouldn't say the limit order book is always dominant over the AMM. I think for depending on what infra you're running on and depending on what pair you're trading and depending on how easy it is for you to find a market maker, so how much flow you have to the pair, the order book may outperform the AMM, it may not. Certainly for the most liquid pairs and the most competitively traded pairs, if you want to condition on market maker or liquidity provider profitability, the order book is going to be better.
Yeah.
The current discourse, as usual, is just like missing all of the nuance. I think there's just this attempt to latch on to, there's this current thing that's doing extremely well, which is hyperliquid, and how do we mold that into my narrative for my token? And so I think it's like a little bit lazy, it's a little bit sloppy, and I don't think the data availability is the most important thing for a limit order book. There's a ton on the that just needs to get done correctly on the microstructure. So it's not just putting the cancels in front of the places, putting the cancels in places in front of the crosses. It turns out there's like a lot of other things that one could tinker with to create the best possible application. But yeah, I don't think that's necessarily what everyone is trying to do.
Thanks to Katana for sponsoring this episode. Looking for the next big chain? Katana isn't yet another new general purpose blockchain. It's purpose-built for DeFi users and focused on giving the best experience possible. It does this by sustainably generating deep liquidity and high yield. If your assets are sitting idle, they're dead. Katana is built from the ground up with DeFi mechanics to bring your bags back to life. All you have to do is bridge over and Katana does the rest of the work for you. Incubated by Polygon Labs and GSR, Katana launches with a notable ecosystem of primitives, assets, and partners, including Morpho, Sushi, Vertex, Lombard, Chainlink, and Yearn. Be early to Katana. Join the pre-deposit campaign before mainnet opens at the end of this month. Deposit funds and open rewards filled with randomized amounts of CAT tokens. There's also a CryptoPunk and other exclusive NFTs hidden for some lucky depositors. Thanks again to Katana. Sol lovers, grab your Ledger Flex Solana Edition now at the link in the show notes. The Ledger Flex Solana Edition is now accessible to anyone who holds SOL in their wallet. Any amount of SOL held on any wallet will do the trick. You'll also get a Magnet Folio, SBT, and $20 in Solana. This is your last chance to grab the custom Magnet Folio and SOL voucher, so don't miss out. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. So for Atlas, like what's your North Star there? Like what do you think that you're really prioritizing as you build that application?
Yeah, so Atlas is designed to be the best possible home for Phoenix. And if it's good for other things, then that's great. But it's probably not going to be great for everything. And that's totally okay. So what does it mean for something to be good for Phoenix? It means, well, there are certainly some basic transaction ordering prioritization mechanisms that you want to put in. We wrote about this, I want to say more than a year ago, maybe almost a year ago. So you want your oracles to land really, really reliably. That means your sequencer, no matter how bottlenecked it is, if it sees the oracle update, it needs to like drop everything else and just put the oracle update in right away. You may want it to do something similar for cancels and places. And the reason you want to bias towards the market makers rather than to the takers, they both do facilitate price discovery, is you have to think back to what is the actual purpose of the exchange. And for us, for Phoenix, it's for retail users to get the best possible prices. And so that means you want market makers to be competing on how good of a price I can give to the user at whatever depth. And the toxic takers or the HFT takers, they get in the way of that. And so if the HFT takers are doing really well, that forces the market maker on average to provide liquidity slightly wider. And we view that as a negative property. It may not, in some very general sense be negative, but our opinion is for this application to be really good, for it to support levels of liquidity that are, as good as centralized exchanges or significantly better than existing centralized exchanges, you may want to prioritize market maker welfare.
Mm-hmm. Do you have to really prioritize perps, you think, to compete as like a exchange?
I think there's a lot of path dependency here. One really nice property of perps is the asset bridging problem is abstracted away. And so for bootstrapping a new chain, whether it's a layer 1, layer 2, or some other type of blockchain, it's significantly easier to just have a single collateral asset. Like a USD, like a bridged USD, rather than every new asset you want to list, you need to find inventory for it and bridge it over. So I think that makes a lot of sense for a new chain to start with perps. I think perps also have very clear product market fit. I view perps as the best known form of leverage. It's I think just like significantly better than options as a product for retail traders.
Why exactly is bridging abstracted away?
So if, let's say I want to have 10 pairs, like the top 10 coins traded against USD. For spot, I need to bridge over USD, and then I need to bridge over those 10 coins as well. And so you're going to have like 11 different assets on the chain. Whereas if all we're doing is perps, then I need to bridge over a collateral asset, which is probably some form of USD. And then the way we trade the perps is through an oracle. So the oracle effectively is a thing that's like bridging the pricing information over. Whereas in the spot world, you're like bridging some like physical representation of the coin. And then the fact that it's redeemable is a thing that makes it trade in line.
Interesting. Okay. I hadn't heard that like benefit of perps before.
Yeah. It makes it significantly easier to get off the ground.
Yeah. Yeah. And this is like a small point, but why? What's the thinking behind the verifiable finance tagline? I've always seen that associated with Atlas.
Yeah, well, I think it's important to be precise. We're not trying to compete on being the most decentralized. And the actual property that we think is important is you don't need to trust the operator or the sequencer for everything. The system will guarantee that the state transitions are all valid. The system will guarantee that if you want to take your money out and the operator is being malicious, you can still take your money out. This is like a very core property of a layer 2 blockchain. But we are going to run the sequencer. and we're going to run it in a way that we think is optimal. And the users may disagree, or some sets of users may disagree, or they may not trust us to run the sequencer in in the way that we claim we're running it, and that's okay. And those people probably should not be using Atlas. But I think it would be disingenuous to call it decentralized when there's a single permission operator who's going to be running the sequencer, which is us. And it definitely grinds my gears when I see other teams with some sort of clearly centralized in many dimensions product labeling as decentralized, and we didn't want to do the same thing.
Is it a DEX then, or is it something else?
I would call it Phoenix. I would call Phoenix V2. I would call an exchange that lives on top of Atlas.
Okay, interesting. Because that seems to go against maybe a lot of the Ethereum L2 roadmap, which sort of holds that these L2s exist to scale Ethereum, but they should decentralize over time. But it sounds like that to you isn't as much of a priority.
No, it's not a priority at all. The priority is to provide the best product to the users. And if that's decentralized, then we'll make it decentralized. And if that's not an important property for the users, then I don't think it's important. I think the really nice thing about the layer 2 architecture and the layer 2 roadmap is, in theory, you can allow for like many concurrent experiments. In practice, I think there's been very, very little experimentation on, like there's this very wide design space for layer 2s. It's not just, are we optimistic? Are we ZK? Do we run this VM? Do we run that VM? There's like so many things you can do, especially around transaction ordering, and almost nobody's experimenting with them. I think most of these changes have like no soul. They have no like real justification for existing. And for us, when we think about building product, the product is always for some user. So Phoenix is for traders, and Atlas is for applications that look very similar to Phoenix. I think a lot of chains out there exist, but may not have like an actual target audience. And yeah, I think it's really important for systems to be like, there's clear need for some systems that are like maximally neutral. So Bitcoin is a great example where by being super censorship resistant, it like may even be beyond the reach of any government, which is incredible for something that's only been around for like 15 years. But the vast majority of systems, like, just doesn't matter. We use tons of centralized systems all the time, and you trust them, or you trust that there's some like apparatus that encourage them to be good actors. Google could tomorrow take all your emails and release them, and they're probably just not going to do it. There's like no upside for them to do it. There's no reason. The incentives are like quite good here, and yeah, I just don't think every system needs to be maximally decentralized.
So why use blockchain at all then? Why not, run it all on some data center chain? Yeah,
so blockchain gives you this nice verifiability property, right? So there's like, what is the level of trust that you want? And on one end of the spectrum is the crypto centralized exchange, where you send your money in, and then you trust that they're going to let you take it out. You trust that they're going to run the matching engine in a way that is valid. Of course, like the physics of the system allow the centralized exchange to just like zero out your balance or never send you your money. And so that's one end of the spectrum. And then the far other end of the spectrum is the maximally decentralized exchange, where the user doesn't trust anything, and maybe even when they're going to send their order, they like hand sign their transaction, write their own code to broadcast the transaction to the network. That's the least trusting, most decentralized way. And I think there's a lot of room in the middle for different types of products, and it depends how much you care about efficiency. It depends on how important the market thinks different properties of the system are. And I think today it's pretty clear the market is not a huge fan of the max decentralization. Centralized exchanges have significantly more users and volume and trading flow than decentralized exchanges. So we'll see where the market goes. But again, like our North Star is always like building great product, and building great product is this very multi-dimensional thing.
Yeah, and why settle to ETH? Like, couldn't you do the same thing on Solana?
I think the importance of the settlement layer is like a little bit overrated.
Yeah.
It might trigger some of the Ethereum people. I think like in practice today, like most of the layer twos are not doing any sort of true settlements anyway. But the properties you care about for a settlement layer, in theory, are very different from the properties you care about in a execution layer. So for a settlement layer, like your layer 2 is inheriting some properties from the layer 1 or from the settlement layer or wherever the bridge contract lives. One of them is that long-term censorship resistance, where if the sequencer goes down and you still want to insert some transaction, you still want to withdraw your money, you're going to go through the layer 1 to do it. And that means you need your layer 1 to have like very strong properties around censorship resistance, very strong properties around like revert protection, fast finality for good bridging. And it turns out like Ethereum has focused on those properties and trying to make Ethereum as good of a settlement layer as possible. Totally separate question of if that's like a good thing for Ethereum to do or not, but they've done it. And I think Ethereum's a pretty good settlement layer. And basically all the other blockchains do not care about it.
Can you explain why a lot of L2s aren't doing true settlement in your view?
Yeah, I mean, you can just go to like l2beat.com. Those guys are really great. They're nits. And I think that's important for a lot of, again, we have like a lot of these systems that are out there and they're just lying to the users about what properties that they have.
Yeah.
So sites like L2beat will at least, keep them honest. But yeah, people say these systems are decentralized or non-custodial, and it turns out just like one guy has the upgrade key, which means they can upgrade the bridge contract to take all the money out. So seems kind of custodial. I think like the non-custodial version has to be something like the admin of the system, if there is one, the operated system, if there is one, even if they went rogue and want to take your money out, they can't do it. And it's just not true for the vast majority of layer 2 chains. Even some things that are calling themselves layer 1 chains today, may not satisfy this property. So, I think it's important to be honest about like trust assumptions, because it's one of those things where 99% of the time it doesn't matter, and then sometimes the retail guy gets hurt, and if this industry is going to self-regulate one way or another. I think like definitions is a pretty easy place to start. It's like pretty non-controversial.
Thanks to Katana for sponsoring this episode. Looking for the next big chain? Katana isn't yet another new general purpose blockchain. It's purpose-built for DeFi users and focused on giving the best experience possible. It does this by sustainably generating deep liquidity and high yield. If your assets are sitting idle, they're dead. Katana is built from the ground up with DeFi mechanics to bring your bags back to life. All you have to do is bridge over and Katana does the rest of the work for you. Incubated by Polygon Labs and GSR, Katana launches with a notable ecosystem of primitives, assets, and partners, including Morpho, Sushi, Vertex, Lombard, Chainlink, and Yearn. Be early to Katana. Join the pre-deposit campaign before mainnet opens at the end of this month. Deposit funds and open rewards filled with randomized amounts of CAT tokens. There's also a CryptoPunk and other exclusive NFTs hidden for some lucky depositors. Thanks again to Katana. Sol lovers, grab your Ledger Flex Solana Edition now at the link in the show notes. The Ledger Flex Solana Edition is now accessible to anyone who holds Sol in their wallet. Any amount of Sol held on any wallet will do the trick. You'll also get a Magnet Folio, SBT, and $20 in Solana. This is your last chance to grab the custom Magnet Folio and Sol voucher, so don't miss out. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Speaking of retail guys getting hurt and, the market potentially needing to self-regulate, something that I've seen you talk on podcasts and panels before about is MEV, which just continues to be a big consideration in Solana where you can play all these interesting timing games. You mentioned earlier that you built Gavel, which is, to my understanding, kind of a sandwich-resistant AMM, or was in the beginning. Maybe just talk to me about how you think today about MEV, and especially like toxic MEV and sandwich attacking, and how that influenced the decision to go and build out Gavel.
Yeah, it's a very broad topic.
Sure, yeah.
When we first designed the sandwich resistant AMM, It was at a time when sandwiching was really taking off on Solana, primarily because there was a lot of trading in these low liquidity meme coin pools. And we didn't see a good way to prevent it at the infra layer, because at the end of the day, the validator does have full agency over what they put into their own blocks, whether they're actively front running or delegating the front running out to somebody else, which, by the way, is like illegal in TradFi, and it's like unclear the legality in crypto. But certainly the protocol itself allows it. The protocol cannot like get rid of it. And so we built a sandwich with an AMM. So first we designed it, and then we wrote what we called a reference implementation for the AMM on Solana. And we kind of just assumed like all of the applications would be super willing to adopt it. So we went to all these order flow originators and like, hey, if you like some meme coin launch pads, right? If you take your coin and instead of graduating it to a regular AMM, you graduate it to the sandwich with an AMM, then your users are literally going to make more money. The coins are almost certainly going to have higher market caps because you don't have a sandwicher just taking money out of the LP. So we thought it was like a very clear win, and maybe we didn't sell it well. Maybe this is just not a top 5 problem for any of these guys. Totally possible. At the same time, we also saw this problem with new coin launches, where they're basically done today in like the most extractive way possible, where most of the products that exist for teams to launch coins basically exist to like fleece the end user as much as possible, whether it's for the sake of the platform or for the sake of the team. And we don't think that the good token teams want to do this. And so like if you're launching a token today, there are like all these people you have to bribe, all these centralized exchange listing teams, like they technically don't take listing fees. And so you have to like, put your coin on their launch pad or whatever. You have to pay off the market makers. And, these things add up to, sometimes more than 10% of your total supply. And so we thought, what if we can create a compelling enough product that can be significantly cheaper? And when I think about costs, it's how much the end users get fucked. So that's like the cost of MEV. And then there's just like the direct costs, which is how much you might have to pay people. And yeah, we thought it should be a pretty compelling product for teams that are looking to launch a token. So you can do initial token distribution in a way that is basically loss-free. There's tons of ways to do this. It's not some crazy innovation. But the goal has to be to do a good token distribution, not to like make the chart look super good. And I think a lot of the products out there for token origination, what is the fundamental problem with sniping? It's the initial price was way too low. The initial price is way below the market price. And why did that happen? Or why is that choice made over and over and over again? It's so the chart looks good. And I think like, if your goal is to make the chart look good, then you should go use some other product. What you actually want to do is have, if you want to facilitate good price discovery, is, like the expected future price of the token might actually just be the opening price of the token. So that's like the sniper resistant piece. You can do like a Dutch auction. You can do, there's just many designs here that totally work. And then the coin will graduate to the sandwich resistant AMM. So some of the proceeds from a token sale, or just the team could put in both sides, go to the sandwich resistant AMM, where you can have more price discovery happen over time. And then maybe after that, coins can move to Phoenix, or anyone can move them to Phoenix. It's totally permissionless, or to other types of on-chain liquidity. But I think it's like pretty embarrassing that like crypto likes to talk about, oh, we're so transparent and everything goes on the blockchain. And then you have this like whole centralized exchange business where it seems like everyone who's launching a token is signing like 12 of these side deals with some like really, really shady actors. And it's just like totally accepted, and it's almost like required. Even things like token vesting contracts, where someone has some token and it has like a 1-year cliff and then some linear vesting after that. That is like the canonical example of the type of thing that you can do on a blockchain, some sort of conditional escrow, and even those are done inside like custody protocols. They're not done on chain.
Yeah.
So I don't know. I think it's a total joke.
Right, and it strikes me as a kind of intractable problem, because part of that story you told is you built this sandwich resistant AMM. I'll just like assume for the moment that it's just like a really good product and would have been better for users. But as you said, from the order flow originators, the meme coin launchpads, maybe the wallets, I don't know who all you spoke to, but it wasn't necessarily top of mind for them. And it strikes me that it might not need to be, because users, I think, tend to be pretty insensitive to like poor price and things like that. So like it's been prophesied for years that Coinbase fees will get competed down, and they just haven't. You still pay a lot of money to...
In fact, what we've seen is Robinhood fees starting at a particular place and then going up.
Yeah, exactly. So I don't know, like how does that actually... Just building a really good product doesn't necessarily mean that users will want it, which is the sad truth. So like, how do you think about actually driving adoption to something like a Gavel?
Yeah, the important thing for Gavel is to get high quality token launches. Mm-hmm. And so, there's always this like reputation laundering problem where, if like you open up the Gavel DMs, there's a lot of interest in launching tokens on Gavel, and it's almost all from extremely like low quality, obvious pump and dump tokens. And then, there is definitely some set of teams looking to launch a token in the high quality teams looking to launch like what we would consider a high quality token over the next 6 to 12 months. And it's just not a very large set. So, I think that's the best way to get real users onto Gavel, is to, have Gavel be some exclusive place to trade some of the, for a short time, not forever, to trade some of these higher quality tokens that are going to come out. And then maybe some launchpad types will adopt it. Maybe they never will. I think there's like this type of market structure that is induced by the users being quite price insensitive. So I don't think they're dumb. I think they just have their own definition of execution quality, which may not be sensitive to 1% here or like 2% there. And when we think about trading, we're thinking about half a bip here, half a bip there, rather than whole percents. But we see the same structure in like sports gambling, for example, where the spreads on sports bets are extremely wide. It doesn't mean that the sports betting companies just like make all that money. In fact, it just like all goes back into customer acquisition and customer retention. So like if you play DraftKings or FanDuel, you'll see there's like always like some promotion that's like clearly a plus EV promotion to play. And that's coming from, it's like funded by the spreads, because it turns out like they don't win, or if they play this game the current way, they retain more users and make more money than if they spent less on marketing, less on customer acquisition, and then also really tighten the spreads. Like the users don't care about the spreads being tight. And so I think we're seeing the same thing with these crypto trading apps where, most end users just like do not care about a 1% fee. And so instead what you should do is you should charge as much as possible, give the user like the worst possible fill they're willing to take, and then give it back in like rake back effectively. Or it's the same as if you're a whale at the casino, then they're going to comp you the suite because they expect you to lose a lot of money at the tables.
Yeah. And rakebacks are interesting because, as you said, you could just charge a lower fee, but it's like it psychologically feels different to be able to claim money
the
back.
user is like, the user is insensitive to the fee, but like somewhat sensitive to the incentive. And so then you want to maximize fee and maximize incentive.
Yeah, even though it's identical. And
and so it's like a very inefficient market structure. It's, same thing with like credit card points, right?
Yeah. I want to ask you about SolFi. So as you mentioned, this was a really interesting story that, like only real like sickos that follow Solana market structure were noticing. But around the beginning of the year, or maybe late 2024, there's these proprietary AMMs that kind of crop up where no one knows who's running them, but they're getting really good prices on like Sol USD swaps and things like that. And a lot of order flow begins to be routed through these instead of other like Orca or whatever it is. I don't know, a couple months ago now, it was revealed that you guys are running SolFi, which is one of 3 or 4 and maybe more coming to market as time goes by. This is something that we've talked about a few times on the pod as just like a changing piece of the market structure in Solana, which is that more and more order flow for, less, not like meme coins, but things like Sol USD that are more liquid is being routed through these proprietary AMMs where it's you don't necessarily know like everything going on under the hood. So I'm just curious to get kind of hear the story from you of how you built SolFi and how you see this new trend playing out over time.
Sure. First of all, I would say it's not necessarily a new trend.
Okay.
Liquidity, which launched, I think, in 2021, was the first to run with this type of idea. I don't think we had the right vocabulary to describe what they were doing at the time. I think they described themselves as a Oracle-based AMM, which, if you zoom way out, is the same thing as AMM is like market-making strategy, and Oracle-based is I have some fair value. So you can use this kind of term to describe any market-making strategy that has some notion of a fair value. So, Phoenix was doing lots and lots of volume, and, we're one of the market makers, sometimes the largest, not always. At the time, probably the largest market maker on Phoenix, and we were looking at all these things that were happening on chain, looking at how the toxic flow is hitting the exchange, looking at competition for the same block space. So, like if you're trading on one Sol USDC market, you're contending with all of the other market makers when you're trying to land your transactions. There's like high compute required, which means higher tips required to land those transactions. And in the same way that Atlas came from our understanding of the Solana market structure, SolFi was our other response. So Atlas is our way to fix it, and SolFi is our way to, if this is a game that is being played, we're going to play it the best. So I think the best way to describe SolFi is this on-chain market maker. At any time, Jupiter or anyone else can query the SolFi contract and say, like, hey, I want to take some amount of Sol, and I want to receive as much USDC as you'll give me. How much can I get? And that's the exact same interface that any other DEX like Phoenix or Orca exposes. Now, Phoenix and Orca may expose many other endpoints as well, but the fundamental one that the aggregator needs is swap, and a simulated swap is effectively a quote. We're just able to provide more competitive prices through SolFi than we are through Phoenix. And there's like a lot of nuance that goes into it. We see that game. There's a lot of games getting played there too. Versus what we consider to be toxic flow that prevents us from providing even better prices to the end users. So this market structure is induced by Jupiter caring about the quality of their fills, because I think it's like quite noble from them, to be honest, where clearly their end users on the website just like do not care if they get like half a basis point of price improvement. There's no way they care. There's no way they know. But Jupiter is like, cares enough to make giving the best price like actually the most important thing for getting the order flow. If Jupiter made other decisions, then I think the market structure would look very different.
And so do you foresee SolFi like providing tighter spreads on like Phoenix than once it launches on Atlas than you would be able to achieve otherwise?
I think in some equilibriums, yes, but in the equilibrium that we're going to push towards, likely not. I think things will not be, so aggregator based. It will not be so fragmented because, we're like driving the whole thing.
For the final bit of this episode, I want to look bigger picture about like the market structure on Solana going forward and how Solana achieves this vision that it's touting a lot in like a marketing sense of internet capital markets, where kind of all sorts of financial services and products come on chain and they're all traded on Solana. I'll begin. You had a tweet a couple weeks ago, I believe, that basically said something along the lines of like the current crypto market structure incentivizes people to create bad fills instead of like good fills. And if regulators catch on to this or something, like this could be negative for crypto. I'm probably misquoting you, so let me know if I am. But I just want to ask you, how can market structure be rethought in a way where it's not like plus EV to, give traders really bad prices?
Yeah, there's a lot of concepts that exist in TradFi that have been sort of mangled in crypto. One example is the market order, where when I go place a market order on, let's call it a regular centralized exchange, no one can see my order ahead of time. And then when my order has its turn in line, it just hits whatever liquidity is on the book, and then that's the price you get. In crypto, we see people are inspecting your market order and putting stuff in front of it and putting stuff behind it. This is, the very normal or well-discussed MEV problem, and the incentives are set up such that the validator is incentivized to be maximally greedy on behalf of their stakers. Mm-hmm. If they're not, then their stakers have economic pressure to move elsewhere, and then that means the validator needs to be building the most valuable block or fucking the transactions as much as possible. And I think the Ethereum folks have a decent solution here, which is, it's better than no solution, which is to send all of the order flow that is execution sensitive through private channels to the validator or private channels to a block builder, where there's a trust relationship or maybe even a relationship enforced by cryptography where, hey, you're not going to front run this type of, I'm going to send you my transaction flow, you can back run it, but you can't front run it. Now there's still stuff around, it's not perfect, but it's a step in the right direction. Whereas on Solana, today the incentive is just to maximally fuck the user whenever you can. If you are some provider on so somewhere in the infra stack. And that is just not conducive to internet capital markets. It is not conducive to bringing good assets on chain and having very liquid markets on chain. Certainly, what we see on chain today is not conducive to capital formation on chain. I think some of these internet capital markets products have been designed in a way such that no halfway sensible, halfway serious team would ever choose to launch something on them. And again, I think it's by design, not by accident. But they're certainly running with the narrative.
We just had Max Resnick from Anza on the pod this week. I think that's the episode that just came out yesterday. And he basically said something I found really interesting, which is that Solana has been seeing better land rates, just as the people at Anza have improved the tech a little bit. And so if you're transacting on Solana, you don't need to broadcast your transaction as widely. And so fewer people are basically seeing your transaction ahead of time, and so there's less opportunity to get front run. So organically, Solana has kind of decreased the amount of sandwiching going on. Is this something you're picking up on as well?
So we're not super aware of all of the sandwiching going on. We're not studying that game too much. Directionally, it sounds correct. But there's other factors at play too, some pushing in the other direction. For example, we're seeing more applications themselves just selling the order flow. That can be at the application level, it can be at the wallet level. They may be sending them to teams that claim they're only going to back run, but maybe also sometimes they front run, and you just assume that people are not going to notice, and they almost certainly will not.
Can you explain what that looks like a little? So a hypothetical wallet is receiving order flow. What does that look like to sell that order flow in crypto?
Yeah, so the most naive example is, let's say I have a Eugene wallet, and someone is on the Jupiter website, and they've connected Eugene wallet, and they're swapping, let's say, Sol to USDC. So what that means is they're going to sign, through the wallet, they're going to sign a transaction that says, I'm sending one Sol, and I want at least 140 USDC out, and then maybe the current price is 141. So that transaction is signed through the wallet, and then the wallet is also responsible for broadcasting the transaction. In theory, to like try to get the transaction landed. But instead, I could take that signed transaction payload and sell it to a MEV shop. Or maybe I sell it in bulk. Like I'm going to sell you a whole month of transactions for, $1 million a month. And I sell them to the MEV shop, and the MEV shop is responsible for landing the transaction. But they may also add something in front, add something behind to
Sounds like a sandwich.
force the user to get the worst possible fill.
Yeah.
So that can happen at any part of the stack once the transaction has been signed. So wallet and beyond, wallet could do it, RPC could do it. Validators who are receiving transaction flow, they can do it.
But that's so like payment for order flow exists in traditional markets, and it's not you're not sandwich attacking because you go to jail or whatever. So
like front running is like generally quite illegal in traditional finance, and then there is payment for order flow, but that's also regulated, where the prices that the end user gets have to be as good or maybe even strictly better than the prices on the what are called the lit books, like the open public order books. Mm-hmm. So when you go trade on Robinhood and you buy some Tesla stock, you're actually getting a strictly better price or no worse of a price than you would if you went to the New York Stock Exchange yourself and pressed the button there. And that's enforced by regulation and like I would say like pretty robust monitoring and controls. And none of this exists in crypto. So payment for order flow in crypto is much more about giving the user the worst possible fill than price improvement.
So then maybe the question emerging from a lot of this is what's to be done? Like, should you just copy paste the regulations that exist in traditional markets into crypto? Should something different be done to eliminate some of these bad incentives?
It's not clear to me what should be done, but it's just not. But I think, regulators, once they like really understand what is happening in these types of systems, part of their job is to ensure integrity of the markets and also to ensure that, retail finance users are not getting boned. And some of them are like probably getting boned in crypto today.
The place I want to conclude is there, to me, has been like a little bit of a tension throughout this episode where you can speak for a long time about all of the issues with market structure, all of the inefficiencies or ways that bad actors are incentivized to be bad. But at the same time, a lot of the things that have true PMF in crypto have users that don't necessarily care. So like on Pump Fund, if people are getting poor prices for like hypothetically, they just may not care. And if you could build a better Pump Fund that gave them better prices, they may not switch to it. So what gives you optimism as a founder that like building more efficient markets matters from a business perspective and that there will actually be demand for better, like more efficient markets?
Oh, I'm not worried about that at all. I think in the traditional world, we see tons and tons of demand when, professionals are trading the assets that actually matter. Revenue generating and revenue collecting assets where people have real risks to manage, real like cash flows that get chopped up and sold in different ways. Execution quality it does matter. It matters at scale, and so I kind of view a lot of the stuff that's happening right now as like it's a little bit of a distraction. It's definitely a good bootstrapping mechanism for the chain, stress testing for the chain, but ultimately, if what crypto delivers to the world is this shitcoin game, maybe even gets like 10 times bigger or 100 times bigger, then I would view that all as just like a total failure. Mm-hmm. So, just because this stuff is happening, it doesn't make me pessimistic at all. I think like the core problems are still the same. How do we create really good markets on chain? And, I think there's some path dependency here too, where you're going to need the market quality to be high for, the like really sophisticated traders to show up.
Is that the target user for Atlas is sophisticated, maybe institutional traders?
Down the road, of course.
Yeah.
The whole point is to bring like real financial flows on chain, ideally to Phoenix on top of Atlas. And so for us, market quality is very, very important. Asset selection, asset quality is very, very important as well.
How much are you able to share now about the timeline on Atlas?
It's coming soon. We can see the light at the end of the tunnel in the next few months, let's say.
Great. Well, best of luck as you build that out. And thank you so much for taking the time to join me here live at Permissionless.
Appreciate it.
Great. Thank you everyone for tuning in. Please give the show a like, 5-star rating, wherever you get your podcasts. If you enjoyed this episode, we'd love if you shared it with a friend, and we will see you all again very soon.